super investors, it's a term for these, I'm going to call them famous investors, where obviously Warren Buffett is probably the most famous super investor. Somebody who's become
Peter Lynch, maybe.
Yep. Peter Lynch, but he doesn't trade anymore. So there's no portfolio for him.
Okay.
Probably a new kind of superstar is Michael Burry.
Oh yeah.
Because he was the big short guy. So we can talk about him. Now I'm a fan of Pat Dorsey. I read his book, his investing philosophy, my investing philosophy. It's like, yeah, I get him. He's that kind of, he's the kind of investor that I identify with. And before him was Peter Lynch. I identified with Peter Lynch, but he doesn't trade anymore. And it's been a long time since he traded.
Yeah, I think I want to read his book. I think that's going to be my next.
Pat Dorsey or Peter Lynch?
I don't know anything about Pat Dorsey, but I know Peter Lynch. You suggested him at some point.
I've read both. I've read Peter Lynch's book several times over. I would really encourage you to read Pat Dorsey's book. I think it applies far better to today's modern time. Peter Lynch wasn't around for the internet. He wasn't around for Facebook, Google, Amazon wasn't what it was today. So I think his world was very different compared to today's modern time. Now, when you read Pat Dorsey, you can totally see that he does have some of that more modern kind of paradigm in his thought process. So I would encourage you to read it. I cheat. I go on Spotify, and all their books are on Spotify. So you could be working and listening to that book being read to you. So here's an idea.
Okay.
So let me go around the horn here. Hey, Brian, thanks for joining. Appreciate it.
Yeah, I missed you last week.
It looks like Pad Harvey. Thanks for joining. Very nice to have you on. And along with Scott, one of the regulars, Mr. N. Kiter. How are you, sir?
I'm good. Thank you. Thank you for inviting me.
Yeah, you are very welcome.
Thanks.
So I had the topic of looking at super investor portfolios and kind of, I'll share my thought process when I go through super investor information and how I try to use that to be a productive exercise for myself and not be overly distracting. And then we can drill into a couple of companies. I was ready to go pretty deep on two companies. One of them is Sprout Social, which is an interesting, I'm going to call them software company that is focused on social marketing and social media. And the other one was Smart Sheets, which is a software company focused around project management. I'm open to, if there's a topic you guys want to talk about today, totally open. Is there any suggestions on topics you came to this call kind of thinking, hey, I'd love to talk about this, or I'd love to talk about this one company?
I have a thought following one of your latest live streams when we or you were talking or got some info about coal-related companies. And I would like, maybe if possible, to take it as an exercise to look at the companies and in parallel to look at the commodity price itself.
Okay.
Because, yeah, it will be interesting. I mean, I have my observation, but it will be interesting, I think, to look at it together.
Yeah, good idea. Let's do it.
Because you sound like excited about the coal because they are making relatively a lot of money and good yield. But again, it's interesting to see that with correlation to the commodity, underlying commodity.
Okay.
Yeah.
Yeah, it's a good idea. Let's go down that thread, and I'll let you guys kind of think about the question, which is, hey, is there a stock or an area you want to take a look at? Looks like Pad, TJT, Lowe's, TJ Maxx, Medtronic. So TJT. Okay, I think that's Target. And let me catch the rest of it. And you want to talk about Zim? I'd love to talk about Zim. Big day tomorrow. Huge day tomorrow. It's their earnings, and the market on Zim, it's been counting that stock out like, hey, they're just not going to be valuable at all. But I happen to think that if they just operate as they should, just normal, even below normal, they're going to exceed the current stock price because the stock was so sold off. It's almost interesting to see how far it's gone down, and it's been rallying a lot. I'm up on the stock, and I think that stock, if they have good earnings tomorrow, I think it's going to be a really good rally stock, and the market looks good for a rally right now. So, all right, so we'll get to a couple of stocks. let me start off with kind of just a quick tour of super investor portfolios. And it's going to resemble, I think, what I've talked about before, but it's useful to see what these very accomplished investors have done. For example, Warren Buffett is awesome, but the one thing I would just call out, I believe that there's a lot of good information in the markets. I mean, we're in the golden age of investing. When I was, let's say 30 years ago, a couple of things. First, I didn't have as much experience investing, but second, there wasn't anywhere near the amount of information available. There's so much information available. The somewhat liability in that is that there's too much information available. You have super investors here. You got 79 that are being tracked by Datarama. That's too much. That's too distracting, potentially. So what I try to do is I try to go to investors that I agree with philosophically and I understand, or I believe I understand, because then I could take what they're doing and I could make it productive for myself. I don't want it to be just a giant distraction where it's just like I'm going in 500 different directions. No, my direction, I'm 55. What do I want to do with my portfolio? I want appreciation. I want to more than double my money every 5 years. Okay. I want to create income because at some point I just want the income from my portfolio to support my wife and I. And those are two important factors. What these super investors are doing is far different. For example, Bill and Melinda Gates, I don't think they need to worry about their living expenses. I do. So they are probably thinking about other things. I know that they get involved in certain kind of global initiatives that are important to them. Good for them. They've earned all that money. They can do whatever they like with it. But I'm not going to follow Bill and Melinda Gates all that closely because I think what they're trying to accomplish is a whole different place and universe than my universe. My universe is, how can I double my portfolio? So I'm going to focus in on just investors where I feel like their philosophy is like my philosophy. Okay. The piece here, I would encourage you to visit this site every quarter because this is where I think a lot of the value is at. If a lot of investors are buying into a company, it tells you about that company. For example, Microsoft. Everybody believes in Microsoft. Well, that's not groundbreaking. Everybody knows that. Okay. All right. So that's an obvious one. But maybe like we're talking about Alpha Metallurgical Resources, right? That one, hey, that's interesting. Does that fit my portfolio? And that's where I think there's more like useful information. Green Brick Partners, 2 investors in that one. How many are in Apple, right? Apple, I think, is really interesting. And I'm going to talk about it in a few minutes. So I'm going to put that one on hold. Equitable Holdings. Those guys are like a life insurance company. Got 4 investors in that one. So why are they investing in that? Why are they investing in Carvana? So we may be kind of seeing a window into what they're seeing, and it might be a good opportunity for us. It may not. And then you can look at the buys, what they're buying into last 2 quarters. And I think I've mentioned, I'm optimistic healthcare is going to start, really ratcheting up. And it's good to see other super investors are buying into CVS. It's beaten down. It's beaten down bad. It's a good dividend stock right now. Humana is a healthcare stock. Solventum is a healthcare stock. Spin-off of 3M. I just did a video on it, released it. So that's where I think there's a lot of value to be gained. But first and foremost, I think that investing should be as simple as you can make it, completely tailored around what you want as an outcome. If you're young and 25 and hey, you know what? I just want my money to grow as fast as I can conceivably grow it without taking excessive risk. I mean, who wants to lose money, right? Nobody does. But hey, you know what? If you have a couple bad years with a couple tremendously good years when you're young, maybe you have a couple bad years followed by years where you double your portfolio every 2 years. That'd be wonderful. But at 55, I tailor around the outcomes I want. No excessive risk, but I do want to grow. I'm in technology. I'm in companies that, if you look at my portfolio, it's really set to grow. In the meantime, I put a certain amount of it into very low risk, like bonds, right? Very low risk, defined, and so forth. So keep that in mind. So we'll look at just a quick peek at Warren Buffett. Now, the market isn't making his reduction of Apple a big deal. In my mind, it's a big deal. He reduced his stake. Now, part of it is he made so much money on it. I get it. But I don't know that he's ever reduced his Coca-Cola stake. He's held Coca-Cola forever. He's held Chevron forever. He reduced it by 3.55. So, you know, he doesn't want to come out and say, maybe he doesn't believe it, frankly, that, hey, Apple's seen its best days, and, you know, how it's going to grow is anybody's guess because they're not growing. I happen to think that Apple is going to be dead money for the next couple of years. It's been doing well over the last month or so, especially as we came back off these lows recently. But I happen to think, you know, I'm reading into that. Warren Buffett is the most recognized investor. And I do believe that Apple is going to be dead money. I could be wrong. I've been wrong about Apple along the way quite a few times. He did reduce his stake in Bank of America, and he's just getting out of Bank of America, which is interesting. But at the same time, if you were in banking a year ago, you're doing great because it sold off so much with that Silicon Valley Bank scare. Everybody's like, oh my God, all the banks are going to go bankrupt. No, only one did. And hey, fair guy, I didn't attend Penn State. I have a son that's trying to complete a PhD at Penn State. So I took him to the airport today. He was visiting us for a while, and he's still on my mind. So I'm wearing Penn State. Thanks for asking. All right. So Warren Buffett is super interesting as an investor. He's a buy and hold guy. It is interesting. He owns Amazon. He owns Visa. These are some of the usual suspects. He owns Kroger. I own Kroger. I own Chevron. I don't own Coca-Cola. He's done great with Coca-Cola, but I don't own it. He also has a long list of investments. It's a pretty long list of companies, and he has investments where they own the company outright. So they're not listed on here because they're not a publicly traded company. So pretty interesting. And then the last thing I'll point out is I guess somebody within the company is a Braves fan because they bought into the Atlanta Braves. So that's interesting. So I think you can, you know, if anything, it's interesting reading to see what these super investors are doing. I talked about Pat Dorsey, and I'm going to kind of fast forward on this one. When I read Pat Dorsey's book twice, and I get what he's talking about. It's like, man, that guy talks kind of like similar to the way I think. Great. So when you look at his portfolio, there's a lot of similarities from what he's doing. Coincidentally, Meta, I own it. Smartsheet, we're going to look at it. I don't own it. I've looked at Wix in the past. I did not buy it. I looked at AutoZone. I did not buy it. I own a lot of my two biggest positions are Meta and Google. Not familiar with this company. I own PayPal. It's one of my big bets. I think they're going to bounce back. Sprout Social, we're going to look at. It looks interesting. I've never heard of this company, and I've never heard of this company, but I'm familiar with Upwork. So in Pat Dorsey's activity, you know, I kind of go, okay, great. You know, I'm kind of identifying with that investor, and it's interesting to see what moves he has. Now, a really famous guy is Michael Burry. The Big Short movie is he's the main character in that movie, and he did make an incredibly accurate bet or call on the shorting the subprime market. I guess to this point, 14 years ago. It's maybe 15, 16 years ago. Man, time flies. So let me stop for a second. Scott, you had a question?
Hey, thank you. Yeah, just wanted to mention something quick, back to Warren Buffett. And it's from it's a passive investing channel that I also watch sometimes. And the guy who runs it, even though he's he's pretty much a full ETF guy, but he does say he owns two stocks. One of them, I think actually two of them are Berkshire and Apple. And he had another perspective on why Buffett might have sold the Apple stock. And his thought was that it may have to do, at least in part, with the thought that income taxes and corporate income taxes might go up. Or actually, let's say there's a very good chance, no matter who's in the office, that corporate taxes will be going up within the next year. Now, I think that could be it. I think that keep in mind that this fellow is the type of really like buy it, hold it, forget what the market is doing, forget who cares about fundamentals, just buy the market. So keep that in mind, but it's just another perspective.
Yeah,
why it might have happened. So that's all.
Yeah, I heard about the tax implications and so forth. But at the end of the day, the most, I think, compelling fact to me is he sold half his stake in Apple. That speaks the loudest to me is he sold, because the taxes are going to go up on every other company he has, right? It's not like they're only going to tax gains on Apple stock. No, they're going to tax it on Amazon and Coca-Cola and Chevron, and you go down the list. So I get it. I get that point. And you know what? Warren Buffett is many times smarter than I am, thousands of times more accomplished and more successful. I'm not going to question it. I'm just looking for facts that lead me to guess at where market sentiment is. And on Apple, its most famous visible stockholder sold half his position. The only way I can interpret that is he just wanted to reduce his stake in Apple and reduce his risk, his downside risk in Apple. That's how I'm going to interpret it. Everybody can interpret it differently, by the way. I'm just going to take it and interpret it that way. I'll reveal to you, I haven't told anybody, but I am shorting Apple stock. I started a short position on Apple stock. I keep adding to it. I think Apple's going to be worth half of its current stock price over the next 5 years. I could be wrong, but we'll see what happens.
You mentioned it in Discord.
Okay. So
could I ask you one follow-up? Actually,
yeah.
Leads me to the more of a general question. Do you pay attention to insider trading? I mean, the legal kind, like Buffett or other shareholders of a company, or excuse me, officers of companies selling, like when they sell significant amounts. So quick example, I was actually looking at Berkshire. I mean, maybe I could even share my screen if it's necessary, but so I have here the insider trading, the trade log for Berkshire Hathaway. And this was back when I was really starting to get serious about investing back in April. And I noticed the month before, yep, here it is, Buffett, Warren, Edward, 50 shares of Class A Berkshire, 31 million. Because it's Berkshire, it's Berkshire Class A, where each one is worth like a house, right?
Yeah.
So that's also not insignificant. I mean, he has many reasons, you know, he's getting older, he has family, et cetera, et cetera. But anyway, I just thought I would get your thoughts on that.
FYI, he's not getting older. He's very old already. And I love Warren Buffett. No disrespect in that comment. I think the biggest risk factor that I see with the Berkshire stock is that you already lost Charlie Munger. Charlie Munger was a genius. Okay. I cannot overstate how awesome Charlie Munger was. You look at his history, just incredible. That guy really knew how to invest. And Warren Buffett is as good, and I would say sees the world a little different, but was a very good partner with Charlie. So when Warren Buffett passes, what's going to happen to Berkshire? That's a real question, because a big part of like that secret sauce of Berkshire, I believe, was in Charlie Munger's head and in Warren Buffett's head. They ran that really fund, which is organized as a publicly traded company, pretty much kind of like their best investing ideas. And the people that are behind them that are doing the analysis, I'm sure they're great. But I don't know that I would believe in them like I believe in Warren Buffett or Charlie Munger. But we'll see how it plays out. Now, back to your point on, do I look at insiders trading? And I'm going to add something to it because it comes up quite a bit. Sometimes young companies grant shares to employees. So let's talk about those two. So I don't pay too much attention to officers selling stock. And one of the reasons is that any logical investor, like NVIDIA, the CEO of NVIDIA has been selling stock. And one of the first principles of investing is it's kind of a double principle, is you should only aim to get wealthy once. And that means once you're wealthy, you diversify into assets that reduce risk and are at sometimes a hedge against the rest of the market. So if you're the NVIDIA CEO and now you're worth billions, do you want to be worth billions in just NVIDIA stock? Well, that would violate the principle of diversification. You need to diversify. And either the CEO of NVIDIA knows this because he's super smart, or people that advise him are like, you should diversify. I mean, he's probably just selling like a couple percentage points of his stock, but that's why he's selling it. That's all logical to me. It's not that NVIDIA is a bad company. It's not at all. Now, that would, of course, the exception to the rule would be a CEO dumps 100% of his shares or her shares. All right, well, that one would catch everybody's attention and everybody know what's going on. That'd be like Enron with people just selling out of their stock. That's a different case altogether, but it's quite normal to see officers sell stock, and it's part of their overall investing strategy, and you can't blame them. You know, just they're aiming to get wealthy once and then diversify. A lot of people are put off by companies granting shares to employees, and I'm not. And here's why. Many of the small businesses, we're going to look at two small businesses today in Smartsheet and Sprouts. The reason that talent went to that company is they want to be granted shares. They want to be part owner. So that's part of the recipe for success. It's been repeated over and over and over again. And just go down the list of all the publicly traded companies, the most valuable ones, and you'll see that a lot of these companies granted shares. So I have no problem with it. And it's actually, to me, it's an asset where you have employees that are invested in the business and are going to work that much harder long hours to make the company successful, because a good part of their, wealth is tied to that stock. So they're going to help the company be successful. So I'm not put off. I know some investors, and they have a right to, are really put off by how many shares of the company's stock is being granted. It liquidates the company. If it's a young growing company, I have no problem. If it's an old, company that's not growing and they are granting too many shares, maybe that would be a problem, but not for me. Fair guy, you got a comment, sir?
Yeah, so I don't know if we are all noticing it, but he bought the stocks at the price of $23 to $26 when the stock was trading at $23 to $26 back in 2016. And I mean, this is adjusted to the price splits that happened in 2020. And now the stock is worth $226. So even if he had sold half of it, he still holds it as his primary position, and he still has about $400 billion in the company. So do you think he might sell more? That's the first question. And so the second question is, it still has like 10 times the price he bought it at. It was 22 to 26. So it has almost 10 multiplied itself at 10 times. So it could very well be his main holding, even for the next 5-6 years. He might just be trimming his position because he made like $400 billion, right?
Yeah. So you are correct that even after he reduced these Apple stake, Warren Buffett, Berkshire Hathaway, still their number one holding is Apple at $84 billion. And you can see my screen, correct? So before that, it was 168 billion, which was really high. The other thing that's going on is Berkshire is holding like $200 billion of cash right now. They're getting out of equities like Apple and going into cash. So you're right that he made a ton of money. Good for him. He really saw value in Apple, and he helped Apple really build this market cap. So I totally understand that. Yep.
Yeah, sorry, I meant 400 million shares, not $400 billion. But yeah, he still has a big chunk of value with proposition for Apple, I think, or else he would have trimmed it a little more, because initially when he bought the stocks that he had for $6 to $7 billion. And right now that has made like so much more.
Yeah, again, Warren Buffett's like thousands of times a better investor than I am. So I'm not gonna critique what he's doing. He's super smart.
I just don't get it though.
I just think of like, would I be buying Apple stock? Well, no, there's a lot of concerns. First and foremost is they're not growing. Okay.
Yeah.
How can you invest in a company that's worth $3.4 trillion that is not growing? Their peers in that space, Microsoft is growing, Google, Alphabet growing, Amazon growing, Meta growing, Nvidia growing. Everybody's growing except for Apple. And Apple has significant competitors, Samsung, Huawei in Asia, as well as around the world. When I travel Europe, I still remember I sat next to a gentleman from Poland. I was flying from Madrid to Berlin, and we talked, and he realized that I was American, and he said, Apple, and he did not like Apple. He's like, I can't believe Apple can charge that much for a phone. I use a Huawei, and he showed it to me. He said, this is an equivalent device. And I said, interesting. I think what you're saying is interesting. And it was hour flight from Madrid to Berlin, but that was like one anecdotal kind of example of the competition that Apple faces. Is Huawei produces a pretty good device. Samsung produces a great device. Google is producing their Pixel. I can go on down the list, and these devices are getting better and better, and they're already AI enabled. Apple hasn't enabled their phone to be AI. So my list of concerns around Apple lead me to short the stock, and we'll see if I'm right or wrong. I think we've got a couple more questions. Let's go to Fair Guy again, and then M. Kiter after that.
Oh, no. I forgot to raise down my hand.
Oh, no problem. No problem. Thanks for your comment. I really like it. So, Mr. M. Kiter.
Yeah, I just one spicy one anecdote about Berkshire Hathaway. And when they initially purchased Apple, it wasn't Buffett nor Charlie Munger idea. It was idea of one of his legends, I think Todd Tomb, or maybe another one, regardless of the name. So one of those that will take the helm after he will go. So they are the one that introduced, and they suggested to buy Apple for $1 billion. And then Buffett said that he was looking into the company, and then he decided to increase the stake. And as I don't remember or don't recall the name, Fair Guy, that said that the initial. The initial price was very low, so it increased in price. Like, I think that the right number is 7-8 fold, because he continued to buy even though the stock was increasing a bit at the very first years. So I think that comparing it to Coca-Cola, for example, is a bit unfair, because Coca-Cola wasn't increasing in price so quickly as Apple did, and wasn't reaching to such a huge size. So it makes sense for him to sell a bit, I think.
Yeah.
But one more, if I may, like personal one, I think that my biggest holding is Berkshire Hathaway. I'm holding it for a few years, and maybe I'm biased. Like, I mean, it's about, I think that about 5.5% of my portfolio. That for me it's big, because I'm very diversified, and I actually trust his successors very much. I mean, I was tracking them and try to listen to them, and I'm impressed. I mean, I personally think it will be surprising, but when he will go, the price will start to move up.
Yeah,
but you know, I'm biased. It's just my personal gut feeling.
Yeah, and
because they are smart. They are smart. I mean, and even now, by the way, the one that runs the insurance business, it's not Buffett. It's this. I mean, I don't remember the names, but they are anyway running the businesses, I think.
Yeah.
Thanks.
Yeah, we'll definitely see how that plays out over the next 10 years, right? How old's Warren Buffett? Do you recall?
I think he's 90 something, right? Isn't he 90?
I think it's, yeah.
I'm going to say 93.
Yeah.
So let me go to AI, because might as well go to AI, right? $93. Okay. So again, he seems to be in good health. Charlie Munger was 99 years old. Okay. If I grow up to be anywhere near like as accomplished, well, not as accomplished, but if I'm 90 and I'm still trading, I'll be like, yes, awesome, man. It's been a great life. And Charlie Munger was bringing it at 95. He was investing in Alibaba and putting his thesis out there at 95. Go Charlie Munger. And Warren Buffett's, still bringing it, although, he's 93. We'll see. Once those two names are out of the company, the new players will emerge. And, it's really hard to replace two of the legends in the industry. It'd be like here in the United States. I'm sure you know who Tom Brady is, right? He's quarterback of the New England Patriots. I think 7 championships, or Michael Jordan. He's more universal. To replace Michael Jordan with the Chicago Bulls, that's just really hard. It's just no matter who you pick, it's going to be a step down. There's going to be disappointment. There's going to be a constant looking over that person's shoulder of, would Warren Buffett have done it that way? Or would Charlie Munger would have done it that way? We'll see how it plays out. All right. So good conversation. I respect all the comments. You guys are dead on. What's great about investing is nobody's wrong, and we will let time decide who's right. All right. So let's move on. We talked about Warren Buffett, Michael Burry. Just real quick, one thing I've noticed about Michael Burry is he's going into BABA, and I don't know that anybody would argue that Alibaba is discounted, but it's anybody's guess as to how investors are going to buy Chinese stocks. It's really unfair that they're discounted so much, but maybe on this occasion it'll work. He's also investing in healthcare, Molina Healthcare. This healthcare payer focuses on companies that pay, like in the state of California, there's Medi-Cal. There's these health insurances that are provided to the poor, and Molina focuses on that space, and it does quite well. It's a really nice growth company within healthcare. So he's buying into healthcare, Chinese stock. So he's betting big on China. That's something I'm drawing out of his portfolio. And he only has 9 positions, which is also interesting. He's going into insurance. We've talked about, in our community, how insurance is working. I own Allstate, but other people have brought up insurance. It's working. It's working quite well. I'm not sure what this company does, but I know that these are e-commerce, and I think Baidu's also in gaming and that type of electronic media. So interesting. I think it's worth a visit just to see what these really accomplished investors are doing. All right. So let's do this. Let's switch gears. And I have 2 companies that I've kind of did the homework on. I'm going to take you through the valuation of 2 companies. These came out of Pat Dorsey's portfolio. These were ideas, and I went through the homework on them. So I'll take you through that. So Sprout Media, what they do is of course, we know that Meta with Facebook and YouTube with, or I should say Alphabet with YouTube and their search business, they make their money out of advertising. So how do businesses that are advertising through social networks optimize their spend? Well, they can use a company like Sprout Social. This is a platform that helps you, I guess, make the selection of where to advertise using social media, and then track how that social media performed for you. Did it really perform by you getting clicks, leads, revenue, that kind of thing? And they are growing. It's pretty interesting that they have been growing quite well. Their revenue has been growing, although they're small. Okay, for the whole year in 2023, they were 333 million, which is quite small, but they are growing at a good rate. It's a space that I think is quite interesting, right? Advertising on social platforms is not going to go away. If anything, it's going to probably continue to expand. So I went through it. I like the company. I like what they're doing. I went through their financials, and I came to, or I should say I did the valuation for them. Now, although they're a nice growing company, they don't produce a lot of cash. So some investors buy into just growing companies at all costs. That's not me. I have to see that the business is really growing, and when they sell something, they get to keep a lot of that money in the form of profit and free cash flow. And it doesn't look like Sprout keeps a lot of the money at the end of the day. They're a $333 million revenue company. They only keep 12 million free cash. That's not very good. So when I do a forecast, even growing the free cash by 35%, and then growing long-term at 5%, which is really optimistic, I only get $446 million of intrinsic net present value of that cash. I'm discounting at 10% because this is a really small company. I want a higher rate of return, higher risk. I add cash, take away debt, and I only get to $500 million of value, but the company is almost a $2 billion market cap company. So it is sold at a premium of 74% if we look at cash. And earnings per share tell a better story, but it's still being sold at a premium of 29%. So this is an interesting little company, but it's just not the right investment for me. I have to see this line get significantly higher. Any questions on Sprout Social or the model that I put together for them? All right. So the second company that I looked at was Smartsheet. Smartsheet has been around a little longer. They too are growing really nicely, and they are a $1 billion revenue company. Very impressive. They get to keep more of their cash, and their trailing 12 months cash looks far better. And their stock has been kind of trading down over the last 5 years. Over the 1 year, it's up 22.67%, and it's offered really nice acquisition prices. Smartsheet provides software for companies that are doing project work, collaborations, things where you need to bring a lot of people together and then work on one effort. And they're growing quite well, and they have a pretty interesting list of customers. Now, when we look at this company, they're growing the revenue nicely. And when we look at their valuation, they produce far more free cash. And I can safely say they're growing their free cash by 25% or more. If you look at their free cash flow growth on their financials. And when I have that growth rate, it produces a value for the cash flows at a 10% discount because this is a small company taking a higher risk. And I get to an intrinsic value of 5.1 billion. They have cash, but no debt, which is very good. So this is a really solid company. But even having said that, it's being sold at a premium of 16% based on their free cash flow. Earnings per share give you a discount of 7%, but overall it's still being priced at a premium. And this is a company I'm going to keep an eye on because I think they have a good growth rate. And if they have periods of time where you have the price really suppressed, I might buy into this company. One, because I think they're just going to keep growing their cash, and as they get bigger, they're going to be valuable, more valuable. But also because I think they're a pretty good acquisition target for a bigger software company to buy them. And that is a second stock that I took a look at. So I'll probably create videos on both companies so you can see like the complete analysis. But those are two companies that I looked at. Neither one is ready. I'm not, on neither one am I ready to invest in them. But I did the due diligence on them coming off of the super investor data that I was looking at. Okay, so any questions on Smartsheet? Go for it.
Yeah, Victor, when you looked at Smartsheet, did you look at competitors? Because I'm looking at their webpage, and like it looks very similar to other companies that looks to me like that they are giving the same, like Monday.com or even Jira, which is Jira is the product that belongs to Confluence, I think. I don't remember the ticker name. It's Australian company. And I think that there are another one or two. So it's interesting if they have any moat or whatever.
Yeah, they compete, and the biggest competitor would be Microsoft, because Microsoft has a product called Microsoft Projects, and there's other competitors that are really big. Now, Smartsheet, I would say, is operating with a total focus on that project management, kind of collaboration management space, where those other companies are not, Microsoft and anybody else. I don't think that Smartsheet has absolute barriers of entry against their competitors, a moat. I just think that they do have a decent moat where their software probably runs better and customers agree with that. That's why they buy more, and more customers are becoming customers, right? More companies are becoming customers. The other thing that they have is, in this business, customers sign a 1, 2, 3 year agreement, and then they have a contract. So it's a very repeatable business, I should say. Like the annual contract value of Smartsheet continues expanding. So that's a very good sign. So there is competition out there. They're not like Google search where, there's competition, but they're way behind. No, I would say Smartsheet is a very good company. That's why I have my discount being 10, discount rate being 10. They're a small business. They can't keep growing, but at some point, will they be faced with, more competition from Microsoft to defend their product, Microsoft Projects? I don't know. We'll see. Good question. Thank you. Okay, so any other questions on Smartsheet? All right, let's take a look at, I think we're going to look at coal, and we'll start with AMR. And then we're going to look at commodity prices. So Alpha Metallurgical Resources, this is a mining company. They sell thermal coal. And the company, over the last 5 years, it had a nice run, and then it's really come down over the last year. It's down from its high, and I like this. I like the graphing on Google better, so we'll go here. So I'm going to look at this high because that other spike I don't think is just useful. But from their high in January, they're down 40%, which is interesting. And over time, they had a very nice run. If you would have bought this stock in 22, boy, you'd be up quite a bit. You have a question, Brian?
Yeah, I owned this back in 22, and they were buying back stock like crazy when it was cheap, right. And that's when it took off.
Well, I hope. Are you still a shareholder?
No, I sold out when it got up to like 250.
Nice work. Way to make money. Yeah, it's interesting how these small caps, because this is a small cap. I mean, they can double, and it's almost like the market doesn't even notice because they're so small. Of course, if Nvidia goes up 20%, the market really notices, and because it's a big market cap move.
And it took off when like Manush Pabrai bought a bunch of it.
There we go. Interesting. So what I like about this business is that you're paying like 1 times revenue. That's good. But it isn't an industry where it's not that popular, right? I don't think coal is going to be around forever. And it's not one of those industries where it attracts a lot of investors. Their revenue has been going down, not too much, but it did go down. I think this is where the stock just started taking off, is when coal prices probably just took off. So let's take a look at, I'm not sure where to look at the best, but I mean, I'm familiar with this website here. Trading Economics, this is excellent. So here's the commodity market, and I'm gonna look at the 5 year. Yeah, so you see here's where the commodity price just took off. And like, if you bought into this company, you really rode this high based on commodity prices. But now commodity prices have really dropped, and I'm not seeing any substantial rally in this price. So I would not expect a tremendous rally out of Alpha Metallurgical Resources, because the commodity prices are not going to support a big rally. Yep. So I think, and Kiter, I think this is kind of like the thought process you want to go through. Any comments on this?
No, exactly. That's exactly my point. Like any other miner, they are the stock price very simply following the commodity price. And as you showed in 2020 and 21, the commodity price was like $30 per ton or whatever the price is. And now it's 132. Now we know that these miners have a fixed cost, their contractors and the salary and so on. and their margin are depending on the commodity price, and that's it. So that's it. And as you said, it's a hated industry. I don't think that it's going to die because it's dying maybe in the US. I mean, the thermal, the metallurgical, which is what AMR is doing, is not going to die anytime soon because that's how you make steel, right? But there is a demand for coal in India and China and maybe other places, which is suppressing the reduction in demand in the US. So yeah, but still, it's coal. It's tomorrow the price can go down, and with it will be the share price. That's why I'm very careful with at least. I have money in mining company or commodity dependent like CBX and Occidental and ExxonMobil and others, but they are simply, I feel more like they are more mature and I feel more comfortable with them.
Yep. Yeah. I mean, if you have a sense of this commodity and you can you have a very good method or ability to see a rise in commodities, this is a really good space for you to play in. I couldn't tell you where coal is going. I have a hard time keeping up with oil prices. I do watch oil prices because I own Chevron, and it's a pretty good investment on my part. But to me, Chevron is kind of a hold stock because it seems like when we go into recessions and stuff, oil tends to do really well for some reason. So it's kind of like when 2022 rolled around, oil was doing great, or Chevron was doing great. Everything else is doing terrible. So we'll see. But there we have it. All right. So let's take a look at some of these stocks. I think somebody want to look at, I think it's Target. Yep. So Target pays a pretty decent dividend. It has a market cap of 66 billion. And let's take a look at where the stock has traded. It did quite well, coming out of the pandemic. Everybody's got money. The government's sending out checks in the United States, stimulus checks. Everybody's going to Target and buying stuff. It looked pretty good for them. When we look at revenue, this is with COVID stimulus. This is without COVID stimulus. So I think that's what we're seeing in the company. This is a very well-run business in a very difficult industry, in my opinion. Retail is tough. And these guys have $106 billion of revenue with $66 billion market cap. Dividend is pretty decent. The analysts think it's discounted by 21%. I think you can make this company, you could calculate a discount on Target or a fair price. There's no doubt about it. I happen to be an investor where I try to avoid retail. I don't like retail, and I'll tell you why. Retail is it's really difficult when we have we get to pick from thousands of companies. We have companies that do things like Microsoft does software, you have NVIDIA does semiconductors, and you have companies that do pharmaceuticals like Eli Lilly. And these companies like Eli Lilly, they don't have to compete against many people or many companies in their spaces where they have patents to defend them from competition. Now, Target, you could say they're clearly in the gray because they have competition everywhere. They have Costco, they have local, they have Amazon e-commerce, which is a big threat to Target. You have a lot of competition. You have CVS selling stuff. Everybody's selling stuff. You could also argue that companies go into the red from the gray in my desirability quadrants of, I want a company up here, right? I want companies like Google is deemed to be a monopoly. I don't disagree with that. That's how good that business is, that the government's like, wait a second, why are you guys like 90% market share of the search business? Well, that proves that's a great business. The competition can't even, begin to compete against Google search. Target, on the other hand, they've got competition everywhere. So I would say that Target is clearly in the gray. It's a very good company, but they have so many issues to tend with. Competition, you have theft, you have expensive leases, of where they have the retail footprint. You have to hire employees. It's very hard to hire employees at Target stores because you don't pay them that much. It's retail. So I could just go on and on of the reasons why I try to avoid retail. And one of the principal reasons is I want businesses here, and I will carefully invest here and here. But retail, for me, I've just lost too much money over the years. And I'd rather own a business that, where's Target going to be in 10 years? I don't know. I know that Amazon's going to be bigger in 10 years. And as Amazon gets bigger, Target's addressable market keeps getting smaller. So for that reason, I would stay out of this investment. But to other investors that are more comfortable with retail, Target's a good investment. It's a good income stock. It pays a 3% dividend. It's a solidly profitable company. It generates good cash flow. And I know this because every time I look at, companies like these, look at the cash flow, nice, 4.5 billion. And if I multiply that times 15, I get up to their market cap, which is very reasonable. You pay a fair price for Target. If you want to be a Target stockholder, you can definitely be a Target stockholder. You have a question, Fair Guy?
Yeah. Can we compare Costco with Target? And I personally would prefer Costco more than Target, but they kind of do the same thing. And the preference of Costco over Target is because of how conservative Costco is over Target. And I feel Target takes short-term decisions that are way more that may affect the company to be more polarized towards a certain side, which might cause them to either fall or actually gain market share. But do you think that's a long-term sustainable model?
Well, so Target and Costco, in my mind, are different. They're both in retail. I agree with that. Target right now doesn't have a clear, Walmart would probably be its closest competitor in type of business. I think Target, Walmart's bigger, but they kind of are a general merchandise retailer. Costco is a membership program retailer, and they really do try to reduce their own cost, and then pass on the savings to the customer. Costco, in my mind, has always been overpriced, but other investors really like the company. Part of it is their consistent growth, great. Cash flow is always good, but the cash flow isn't incredible, right? It's just good. $7.4 billion, and you're paying plus, $386 billion for the company. So you look at their free cash flow yield, it's not very good. So you have, I'm going to do the math in my numbers in my head. It's about a 2% free cash flow yield, which is not very good. I think Walmart would be a better compare against Target. And then I think there was another retailer that you wanted to look at, which is TJX. TJX has been a good performing stock. Oops, looked at the wrong.
A quick question. Sorry to interrupt. Why do you think Costco is much more? It's considered a better stock by the investors over Target. Then
I didn't catch your phrase. Say it again.
Why do you think the investors think Costco is better investment than Target?
Well,
I don't know myself. That's why I'm asking.
It's just, so it's a very popular stock. Charlie Munger loved Costco. He loved Costco, loves the membership program, brings in a lot of consistent revenue, which is good. And I think it's a very popular stock. Look at their market cap, $385 billion for, I think it used to be called a warehouse retailer, right? They have a big warehouse. It's a membership. You have to pay an annual membership to shop there. It's a very popular stock. A lot of people own it. So looking at TJX, TJX is a discount retailer, and they're more valuable than our friends over at Target. Twice as valuable. Target has higher revenue than our friends at TJX. Isn't that interesting? You got double the revenue, and this company is double the market cap. These guys operate in the discount retail, off-price retail. So they're really pushing volume. They also have their stores are smaller, so they don't have to pay as much for leasing space. So their operation is less expensive to operate. They pay a very small dividend, 1.35. And the revenue has, look at this here, but that's because they had a terrible year in 21. Then they had a nice growth in 22, and they've been consistently growing, pretty much like Costco. We look at free cash flow, $4.2 billion of free cash flow. And our friends at Target have $4.3 billion of free cash flow. So if you were going to give me $1,000 of one stock or the other, I would take the Target stock over TJX because it's giving me better free cash flow at a better discount. Analysts are saying that it's a strong buy, but it's fairly priced. Target, analysts are saying that it's a buy and it's discounted by 21%. So if you were going to give me $1,000 of stock in one of these companies, I would take the shares of Target. That would be my preference. I wouldn't buy any retail stock. I just don't like retail. I'd rather buy a good technology stock, a good communication services stock, a stock that I think is going to be worth a lot more in 5 to 10 years. And retail, it just keeps getting harder and harder and harder. Macy's is almost bankrupt. It's not a surprise. It's not a secret that retail just keeps getting harder. All right, so we covered retail. Any last thoughts on retail before we move on to Medtronic?
Just a question: how is Target performed in recessions?
How do they perform in recessions? The good news about Target, see, like, remember my earlier statement, Walmart and Target are really good compares. Here's an article comparing the two. Target's gotten into food, the food category. And I think that's part of their being more recession resistant, because you can go to Target to pick up, your staples like food and eggs and, things that you need to buy. And while you're there, you're like, oh, that's right, I have to go buy some laundry detergent. Oh, I have to buy this, or, oh, I need to buy a new charger for my phone. So they're really improving their foot traffic by having their grocery section to the store. That was a strategic item that they had, and I think it was a good one. I think it's made Target more recession proof. So they're more recession proof if you get people in there buying food, because whether you're in a recession or not a recession, you're going to eat. And Target does provide a pretty good value proposition. It's not the cheapest, but it's a very good value proposition. They run good specials on food. My wife shops at Target quite a bit, and that's probably one of her go-to stores. All right, anything else on retail? All right, Medtronic is a med device company. I've heard of them. So pharmaceutical device, in their case here, they have medical devices that help in the cardiovascular area of illnesses and conditions. So they're doing pacemakers, defibrillators, and things of that type. Looking at the 5-year, wow, stocks looks sold off over the last 5 year. Over the last 1 year, the stock's pretty flat. You could have picked up the stock at a pretty good discount in October, late October. The revenue is real nice, 108 billion. It's 3 times their revenue. They pay a nice dividend at 3.3%. The revenue has been growing recently. Very good. Very consistent company. Healthcare tends to be consistent, and it is recession proof to some extent. It's not like people are out there going, hey, you know what? I think I'm going to get a pacemaker. No, it's usually your doctor says you need a pacemaker or you run the risk of dying. Okay, I'll get a pacemaker. And then you go through your insurance, you get a pacemaker, and you're good to go. And then from there, I don't know if there's any maintenance on a pacemaker. I'm not an expert there, but I do know healthcare companies, and I tend to like them. Looking at their free cash flow, 5.2 billion, very nice. Very nice. So 5.2 billion. And remember, we were just talking about our friends over at Costco. They do 253 billion of revenue, and they do cash flow of 7.4 billion. This is a med device company that is 1/8 their revenue, and they do more than half of the free cash flow as this company. But if I look at their free cash flow, it's 5.2 billion. This is a med device industry. This is going to be fairly priced, and probably priced at a small premium, in my opinion. It's a hold according to analysts, and they're saying that it's discounted by 6%. So this one here doesn't knock my socks off from a valuation perspective. The market corrected the price, brought it down to $84 a share. It's probably closer to its fair price. I don't know that they have any new catalysts for growth. Like, hey, we're going to come out with this new product that's going to expand our revenues. The revenues have been fairly flat, right? So it's not like the company's going to dramatically change to the positive. So this is kind of just a stock. It pays a dividend. I don't expect huge returns from a stock like this. I'd rather look at a stock in this space here. I don't have a stock that I can think of on the fly. Med device. I can't think of a med device stock. But I could say in healthcare.
Isn't your recent stock, Solventum, is med devices?
No, that's a good question, but it's not med device. That would be healthcare. And let's talk about Solventum real quick. So the difference between Medtronic is these guys are creating like pacemakers and defibrillators. And these are actual like devices, almost like technology that is used to help somebody with a condition they have. Solventum produces products that are used for surgeries. They're used for dental care. and it's almost like the materials and I'm going to call it the items they need to conduct a surgery, to give somebody like a surgery in the hospital, as well as like in the dental offices when somebody gets a particular implant installed, a prosthetic tooth. They provide all those items and materials for a dental and a medical office, as well as hospitals in the surgery room. So they're related. They're both healthcare companies, but they're different types of healthcare companies.
I understand. Thanks. Yeah, it's a good explanation. Thanks.
Yeah, Solventum, I think you can watch the video there. I like the stock. I'm buying into the stock. But what I was going to say is Medtronic to me doesn't scream out like, hey, this stock is going to be worth $200 a share in 5 years. It doesn't scream that. Pfizer does. Pfizer, was here. And Pfizer, when it got a COVID vaccine, it just took off, right? Hey, we're going to have a COVID vaccine to help with the pandemic. It was up, it doubled in price. And then when the market realized, well, we're not going to need COVID vaccines forever, the stock went down 43%. And the market's like, yeah, this company, and I'm not looking at the right company. Sorry. This graph's even better. So when the market said, oh, you have a COVID vaccine. Yes. Okay, well, we're going to double the value of your company. Wonderful. Now, once they said, oh, we're not going to have COVID forever. No. Okay, we're going to discount the stock as a stock market by 57%. So you would say to yourself, wow, the company is 57% worse. What happened to their revenue? Now, what I really like seeing in Pfizer is, here's revenue. Before COVID, okay, they were a $41 billion company. After COVID, they're 58. So they've grown organically to their base business, right? The COVID years, they more than doubled. But we're going to take those out of the analysis. I really want to compare pre-COVID, after COVID. The business is bigger. During these years, they generated incredible cash flow. 26 and 29 billion dollars of free cash flow. 56 billion dollars of free cash flow. They bought a big company that has treatments for cancers, and that company is going to begin to grow here in 2024, 2025. This number of revenue is really going to take off on Pfizer. And this is one stock that I expect is going to do better, a lot better than it's done over the past. And again, the market sometimes just is really irrational, and it really discounts stocks quite a bit. The stock's up a little bit, from their low, not breaking any world records. But back to the statement I was making is, do I expect Medtronic to be worth 100% more, if not 200% more in the next 5 years? No, it would surprise me. But I would not be surprised if Pfizer is a $75 stock in 5 years. It would not be a total shock. I'd be like, of course, the market had sold it off so much. This could be the next meta example where you have a company that was sold off by the market. The business hadn't changed, but the market said, we're going to discount it by 76%. And investors that took advantage of that saw their investment really go up. I think it's going to be more like this in the case of Pfizer. So that's my comment on Medtronic. So let's talk about Zim, and then we'll start putting a wrap on this call. Very similar to some of the graphs we've seen, right? This is with the supply chain constraints that COVID caused. Shipping rates just exploded. It went sky high. And then the market said, no, this company's terrible, worthless. Let's bring it down by 91%. Nuts. The company's better. It's stronger. And I'm willing to bet that it's going to be worth a lot more tomorrow night. We'll see. But you see that, man, the market just irrationally discounts companies at times. And if you catch them at the right time, you can really see an investment take off. The fundamentals of Zim, keeping an eye on free cash flow, right? Free cash flow has always stayed positive. So what do you mean, stock market, that this company is 91% less than it used to be? That's ridiculous. Their cash flow was exceptional in 22 and 21, and it's gone down substantially from, let's say, 5 billion to 1 billion. It's a reduction of 80%. But from here, they're going to grow because shipping rates have been better. So overall, the price is so discounted on Zim that it doesn't take a lot to make this stock really rally. It's at $19 a share. The high point of this stock was $84 a share. So at $19 a share, it could go I have an exit strategy at $30 because at that point I'm like, great, 3-bagger, I'm done. See you later. I'm calling it a day, and we'll see what happens tomorrow. None of what I ever talk about is financial advice. I'm not recommending you buy, hold, or sell any of the stocks that I talk about, but that's how I see Zim. Thanks for the question on that one. Any questions on Zim? Fair guy.
Not on Zim, but do you have any suggestions about VTRX, Vertex Pharma? We were talking about pharmaceuticals. So
yeah, I've looked at Vertex, and let's take a look at it again just to refresh my memory. So this is a $5.5 billion company, 617 million. They are growing. I want to remember. I think these guys do what I call generic pharmaceuticals. They don't own the patents. They wait for drugs to come off patent, and then they start selling generics. Free cash flow really went up. Wow, 100 million in the last trailing 12 months. So 100 million. Yeah, 100 million. So 100 million.
Actually, they had the most number of patents that they have ever filed in June this year in their financial calls. So I think you might be talking about some other stocks.
So Vertex. So this is a software company. So Vertex.
Oh no, Vertex Pharma.
What's the symbol again?
VTRX.
BT. So
Oh no, VRTX. Sorry.
This
There
one,
you go.
Vertex Farm. Okay. Okay. So biotech. Okay. I like the industry. And market cap 123 billion, $10 billion of value. So investors feel like this is a very valuable company. They have patents and so forth that make them valuable. Looking at the 5-year, it's been a stock that's really done well. Very good. It's been going up. So revenue has been going up consistently. They really had nice growth. And the growth is slowing down because the company's getting much bigger, right? They continue to grow nicely, but as the law of big numbers, as your number overall gets bigger, it's harder to grow at a very high percentage rate. So this one is, now are you familiar with this company? Do you know this company really well?
I don't know it too well, but I'm looking at it now, and I thought I could bring it up here because everybody could be educating themselves on this.
Okay, very good. So, I mean, their 23 free cash flow is 3.3 billion, but then they have the trailing 12 months is not looking good. Looks like they're probably putting money into a production facility or something. This one's going to be hard for me to to value because the best I can do is get a valuation up to like 60 to 80 billion dollars based on that cash flow number, doing it in my head. It's just going to be very hard. Principal reason is that over the last 5 years, the stock's really done well. So any kind of premiums already priced into the stock. It's hard for me to say, yeah, this stock's going to be worth 100 to 200% more in the next 5 years. It'd be very hard for me to make that statement rationally, unless you see that they're starting a new drug that's going to be big, or they acquired a company that has a big drug or some type of treatment to a disease that is in high demand. If there's something like that going on, that's why I asked, do you really know this company? Are you aware of some information that should be taken into account as we value the company?
Yeah,
so
yeah.
Here would be kind of I probably wouldn't spend much more time looking at it because I don't think it's a very good investment.
So they bought a company called Alpine Immune Sciences, and that was a big. That's the reason why they had a negative cash flow.
Then you could do some homework there, and if you have an information advantage, maybe it changes the picture. But I couldn't get close to a valuation of 123 billion. I'd be below that. I'd be at best around 80 billion, and it'd be like, nah, it's too much of a premium.
I agree. That's right. Okay.
Yeah. Thanks for bringing that up. All right, everybody. So we had a nice, lively session. Thanks for bringing some good stocks to look at, and thanks for being so active on this session. I really appreciate it. Everybody, and Brian, you've got a question. Go for it.
Yeah, I don't know if you saw my question early on. I was asking about Bit Digital, if you know about them, or GOGO or Immersion.
Okay, let's take one at a time.
Oh, Bit Digital, they used to be a Ethereum and Bitcoin miner, and now they've kind of morphed into the data center with all their GPUs they had left over from the Ethereum mining.
That was smart.
And they had a contract they got last year for $100 million. And just in June, it got bumped up to $275 million for 3 years. And that's just one customer for their high performance computing.
Man, thanks for bringing this one up. This just sounds really interesting. So
And most people just still think they're just a Bitcoin miner or Ethereum miner, but they do stake some Ethereum, but because they had some left over.
yeah, I know what you're talking about. So these guys, so I understand. Thanks for bringing up and giving us a quick overview on it. Let's take a look at their financials. So it's market cap's really low, 434 million, $66 million. Look at this net income. That's
Well, they just started getting income from their HPC computing starting in January.
man, this looks really good. So yeah, 266% of growth is pretty good. That's phenomenal. Wow, incredible. Okay, so the stock, wow, look at that. So when Bitcoin was all the craze was here,
Right.
it's a low stock price. So let's kind of like quick checklist of why is this. So I love the revenue. I love the new profit. I'm good with that. Let's look at the balance sheet. Is there a big problem on the balance sheet? How much?
Not that I could find.
Let's see how much debt they have. So total, they don't have debt, huh?
No,
And they have cash.
they've got Ethereum and they got Bitcoin and they got cash.
And they don't include cash and cash equivalents. They don't include their Bitcoin and Ethereum in there.
Oh,
Not a super important question.
I think they do, but I don't remember. I've been looking at so many of them.
How did you find this one? So first, good job. How'd you find this?
Oh, because I still have one of my Bitcoin miners, CleanSpark. I still kept a little bit of them, even though I sold most of it off last December when it peaked. But I still have some of them, so I do track them a little bit.
So these guys are taking their accelerated computing capacity and saying, "Hey, if you want to build an AI model, we'll let you use our capacity to build your AI model."
So right now they just basically they're buying they're buying more GPUs, but they already had some, and then they're buying servers, and then they're basically saying, "Hey, we'll set this up wherever you want it." So the one customer they have now, I think, is like in Iceland or something. So they don't actually physically own the data center, but they basically just rent a space and then provide that for the customer.
All right, man, this one's a good one. So this is a great example of a stock that is misunderstood, and for good reason, right? Hey, we're going to be a Bitcoin miner, and everybody's excited about it 4 years ago. Market tanks, so they sell this stock off like it's just useless. They've reorganized their business and said, "Hey, well, we got these GPUs that are super valuable. No argument there, and let's aim them at a market that really needs them right now, AI." Okay, this is not rocket science. We could turn it into that, but let's not do that. That totally makes sense to me. So I'm trying to get to their, and I thought this was going to be easier, but
Their earnings are tomorrow after the market.
BTBT. Well, all right. So we don't want to go there. We want to go here. I'm trying to get to their financials. You know, I like the app that I'm showing you. So, but sometimes I like looking at the real life financials just to make sure I'm not seeing the wrong numbers. So revenue's up 266%. Wonderful. Cash at 35 million. So they do include their digital assets there. Okay, cool. That's fine. That's fine. I have Bitcoin. I have Ethereum. Got nothing against that.
Well, and they stake their Ethereum to make some money too.
I do as well. Okay, so for 3 months ended, man, so there's that. So let's look at their cost, right? See, high performance computing. This is why NVIDIA is worth so much right now, is there's not enough GPUs, and these guys had GPUs.
Yeah, they had to buy some more when they upped that contract though, and they have to buy servers.
Yeah, the server stuff isn't that expensive, right? You're like
Right.
buying a commodity. So
Right.
So here they went from losing, I think this is in millions, 2.2 million, to making 50 million in profit. Okay, so we got our good. Okay. So these guys look good. Let me look at their cash flow. And the font's super small. I apologize, but it's not my fault. It's kind of like this is how you put it out there. So this is where you're talking about they're putting a lot of money back into the business, right? So digital assets mined. So negative cash. So right now they have negative cash flow because they're putting, the biggest item is this, which is digital assets mined. Digital assets earned from staking.
They still do mine Bitcoin, but they aren't using all their exit hash. So I don't think they're that profitable right now. In fact, they're losing money.
We're seeing
But I think they use that and they convert it to Ethereum to stake it.
So why do they burn so much cash if they're making so much profit? So this one's totally interesting to me, and I'm going to spend some time and energy on it.
So like I'm saying, they had to go buy a whole bunch more GPUs though when they upped that contract to 275 million.
You understood? And the market for this company, the stock price for this company,
It's a little under 3.
so they are up 11%. Why did they sell off recently?
I don't know, because they basically moved with the other Bitcoin miners because everybody just still thinks they're a Bitcoin miner.
And this stock price, I'm sure it doesn't make anybody feel comfortable. Man, this might be worth throwing $1,000 at it, seeing what happens. This is a really, really good stock. I'm gonna kind of try to unravel this thing and see what the heck I think is gonna happen. Now, on my stock investing channel, oftentimes I come out and say, hey, I invest in Bitcoin and Ethereum, and I get a lot of thumbs down. Oh, boo. And what I would say is the reason I invest in Bitcoin and Ethereum is that the whole world is digital now. We're connected, and a digital currency totally makes sense. And if anything, I was investing small amounts so I can learn something and have the capacity to understand what the heck it is. Now, here's an investing idea where I understand what mining was, Bitcoin mining. I understand the Bitcoin, Ethereum universe, and I understand AI. I understand AI quite well, by the way. And I'm like, wow, this is a pretty good opportunity. But I wouldn't have realized that if I hadn't invested the time in understanding Bitcoin, Ethereum, its marketplace, why it exists, why do investors like it, and then being able to put those kind of different bodies of knowledge into looking at a company like this, which might be a pretty neat little opportunity, similar to like a Zim, where it's misunderstood. If you get ahead of it, maybe it's a good winner, and it'll be a winner quite quickly because the GPU demand is extreme, and it's not going to go away for at least a year, maybe a little longer. But I happen to believe that AI is being overplayed. There's just too much hype. But for this company, go into it, and let's say I do check all the boxes and feel comfortable going at $3 a share, have an exit strategy at like 9 and exit, because this stock could go up to 9, 10 and then drop back down to 5 because it's done it before. It just did a drop recently of 30%. And if you look at the 5-year, holy smokes, it was only down 97.5% at one point. Thank you for that suggestion. What other stocks were you looking at?
I was looking at GOGO. They basically do Wi-Fi for like business jets.
Well, they also do it on commercial airlines, right?
They're more private or business as compared to like Starlink. I think Musk, I think he does it more for commercial.
The reason I say they're on commercials is that I've used GOGO on flights.
Oh, they put them on, but they also put them on a lot of the smaller ones.
Okay.
And right now they're just about to go into.
This is a very good idea. You know why? So I'm looking at the right stock, right? GOGO?
Yes.
So the number of flights right now is at record levels. The number of travelers, record level, record. So you got a lot of butts and seats that want to be on Wi-Fi.
And right now their Wi-Fi is just North America because it's just the plane to the ground, but they're going to get into the low-level satellites with their new product they're coming out with, I think, next year.
Okay.
So then they can go global with that.
So $915 million market cap, 402 million in revenue. So you're paying a little over 2 times revenue. PE is ridiculously low. Let's see what kind of growth we're dealing with. Okay. So they were growing quite nicely here. Why are we not seeing growth here? Did they change business models and say we're not going to do commercial anymore? We're going to just do
No,
private?
but they're transitioning from the 4G to 5G, and then they're spending a bunch of money on their Galileo, which is their one that will be satellites.
Okay, so cash flow. They've always cash flowed. Very good. So this is the quarterly. Look at annual. So 80. This is a good idea. I'm going to do more homework on this. Are you on the Discord?
No, I tried getting on, but it said it's expired every time I tried.
All right, I'm sorry about that, but the new Discord, and I'm going to put it on the chat here. I kind of made everybody aware I'm new to Discord, and so I created a link that will not expire.
Is that under the community link?
I'm going to give it to you. 1 second. 1 second. So here, I think this one will expire, but not for 7 days. So let me put it in here. Can you see it there at the bottom there?
Yeah.
Yeah, join, and then because I think that we can carry the conversation further once I do some analysis. I'll try to put it on the Discord, and you obviously have my email address. If that link didn't work, email me and I'll figure it out. But the new Discord link that I put on the community page within the YouTube channel, it has a link that shouldn't expire. The previous one did expire, and I apologize for that.
Okay.
I set it up, I think, appropriately. And was there another company that you were looking at?
I got a whole bunch, but the other one I asked about was Immersion, IMMR. They're a haptech technology.
They're a
You know,
what
like-
technology?
Haptech, like it makes your, like if your steering wheel, if you got like, it wants to get you in the right lane, your actual feel will shake your, or it's the same thing like on your cell phones, or if you're playing video games.
So you said EMMR?
IMMR.
And what's their biggest market? Automotive? Or gaming?
They're automotive, cell phones, gaming. They got lots of patents.
Jeez, PE is super low. Man, the volatility is really crazy here, but good. You could have bought at 679 and it popped up to 10. Very good. Let's come back down. Okay, so these guys, wow, look at that growth. Okay. So these guys are small, 341 million, 70 million in revenue. So do you have an idea of why they're growing so fast in the latest quarter?
No, I just started looking at them again because I bought them back in 2021 because I like my son was doing all the gaming stuff, and that's why I was looking into that stuff and also the cell phones.
Well, whatever process you're using to find interesting stocks, it's very good. Because these are three that I'm going to do some homework on.
I got more.
Well, use the Discord. Put them on the Discord.
Okay.
And then we'll go from there. But this has been an
Okay,
awesome
thanks.
session. I'll take a look at those three and then get on the Discord and tell me the others. There's a channel that is high growth. Use that one. Growth stocks, and then we'll actually small caps. These could either be small caps or growth stocks. I don't think anybody would mind it being in either category. All right, good stuff. Everybody, thanks for bringing it today. I got a lot more than I gave today. I appreciate it. Thank you. And everybody enjoy your Sunday. Let's see how the market, hopefully the market continues this rally we're on. I'm okay with it continuing to go up and to the right. With that, everybody have a good night. Bye.